Good afternoon, all. Welcome to today's section. Today is Sunday, the 7th March 2021. Okay. Thank you for your patience. Okay. Yesterday, we closed the bit by having a form of task. The first thing I'll put to us is there anyone who tried to attempt the task or who perused the task with the sole purpose of having better understanding and appreciation of it? Is there anyone? The task is what is presented before you. Nuruddin?
No, I have not attempted it.
Okay.
I think based on Rose plea yesterday, you said we are going to have the discussion on it next week.
No, I didn't say we have discussion on this. I say I would rather give you till next week for you to have attempted solving it.
Okay.
It was due for today before, but based on this question, I said that means you need to go back and have exposure to understanding the aspect of income tax effect on it. Can you remember?
Yes, I remember.
Okay. Any questions so far before we proceed on our discussion today? Marianne? Akinfolarin? Any question?
Good afternoon, sir. Not from me.
Okay. Okay, let's do something today. Next week, you'll be having someone introduce some pertinent topics to you. And what I have today, which is this chapter 8, we might not be able to wrap it up before then. Therefore, what I'll do is I might take opportunity to solving this question now. Okay. And you will start introduction to presentation of financial statements and some other cogent aspects from next week's Saturday, which one of the industry professionals will equally be bringing that to the table. Okay, and that's what we're going to do for next week. And next week, we're also going to move to other aspects, which the person is going to present to you guys. But let's move ahead. I think what I'm going to do is, let's go back to this question and we'll read it and we'll attempt solving it. Okay, who will volunteer to read? Okay, I think today is International Women's Day or tomorrow. Let me allow the women to take the floor today. Okay, Miriam, kindly read the question. What a man can do, a woman can do it better.
Okay, Pico, sorry, Pico acquired 75% of the ordinary shares of S.
I think your network is poor.
1st September 2005.
Yeah, Marian, I think your network
At that
is
date, the
poor.
fair value of S on current
Your network is poor.
asset was
Sorry, can you pause a little bit? Can you pause?
Yeah.
I think your network is very poor. It's breaking. Is it breaking from other people's end?
Yeah.
Yes, okay. Is Bemi there? Can Bemi read the question? Is Bimi there?
Bimi is here.
Bimi?
Yes, can you hear me?
Yeah, your voice is very low.
So PICO acquired 75% of the ordinary shares of ESCO on 1st September 2005. At that date, the fair value of ESCO's non-current assets was $23,000, greater than their carrying amount, and the balance of retained earnings was $21,000. The fair value of the non-current assets does not affect the tax base of the assets. The relevant tax rate is 20%. The statements of financial position of both companies as at 31 August 2006 are given below. ESCO has not incorporated any revaluation in its books of account. The non-controlling interest is valued at full fair value, which was deemed to be $18,000 as at the date of acquisition. Then you have the statement of financial position. The total assets is $196,000, current assets being $82,000, non-current assets being $114,000. Equity liability as well. Statement of financial position as at 31st August 2006. Now, if ESCO had revalued its non-current assets as at 1st September 2005, an addition of $3,000 would have been made to the depreciation charge for 2005 and 2006. What is required? Prepare PICO's consolidated statement of financial position as at 31st August 2006.
Okay, thank you very much. Okay, from this question, can we identify the critical principles that underline the question? Hello? Are we there? Can each one of us identify the critical principle underlining this question? I can't hear Shegun, I can't hear Nuruddin, I can't hear anyone.
From what I itemized here, I know that it has to be some of the principal tests in this question is number one is fair value adjustments. Number two is the understanding of tax base. Then I can say non-controlling interest was measured at fair value. Those are my observations.
Okay, who else? Anyone else?
Okay, another thing that I would just add to what Nuruddin has said is that there is an additional revaluation of $3,000, which was not incorporated as at the date of acquisition, because there's a statement up there that said the statement of financial position of both companies at 31st August 2006. Okay, I give him below. ESCO has not incorporated any revaluation in its books of accounts. So that means that upon acquisition, there is a revaluation, or there is a 3,000 additional
Depreciation.
revaluation that was not incorporated. So I think we need to account for that while preparing the group goodwill and the identifiable net assets, I want to believe. And also there's a statement that says the fair value of the non-current asset does not affect the tax base of the assets. So that to me seems as if we won't be having any temporary difference between the non-current asset and the tax base, because it's saying the fair value of the non-current asset does not affect the tax base of the assets. So that's just my additional contribution.
Any other contribution as we move on?
We'll go with what they both said.
Okay. Now let's pick it one by one. Now we have no problem with the information about PICO acquires 75% on this date. As at that date, we are told that the fair value of S non-current asset was 23 million greater than its carrying amount. Okay, now the second problem we have is the fair value of the non-current asset does not affect the tax base of the asset. Who can interpret that statement? What is the relevance of that? What is the relevance of this?
That to me seems the carrying amount is still equal to the tax base.
No.
Okay.
They said the fair value of the non-current assets does not affect the tax base of the asset. What does that mean? What it simply means is that when you fair value is an accounting issue, it has nothing to do in changing the tax written down value of that asset for the purpose of taxation. Which means when you revalue an asset, it only affects accounting purposes. It doesn't affect any basis for tax computation, nor capital allowance, nor anything, because for tax purposes, such an asset is not adjusted for market prices or evaluation or inflation, as the case may be. But in some jurisdictions, qualifying capital expenditure are adjusted for inflation. They call it inflation adjusted, which means that when there is evaluation, that same amount of evaluation, subject to what is acceptable for tax purposes, is adjusted for in the tax written down value, which is the tax base for such an asset. But what they are saying that in this case, the evaluation you have done on your asset will create additional temporary difference because your tax base remains what? The same, which means your carrying amount will now be higher in principle than what the amount of tax base is, given that you adjusted the carrying amount upward and you left tax base to remain unchanged. And that gives rise to taxable temporary difference at the point of acquisition, which means you are now trying to link our understanding of IAS 12 with our understanding of IFRS 3 regarding fair value measurements. But we'll get there. Okay, now let us start. The first is to put up the structure. What is the structure? What's the name of the parent? PICO. Acquired what? ESCO. What stake? 75%. It then implies that NCI is 25%. When was the date of acquisition? Acquisition took place 1st of September. Let's say X means 2015. And we are reporting when? That's 1st of August, X6, let's say 16. How many years apart? 1 year. Now the reserve comprises of retained earnings. And retained earnings of ESCO is 41 as of today. Whereas when we acquire, the retained earnings was 21. Therefore, we carry out an analysis. ESCO retained earnings as at reporting what? Date. All figures, I assume is naira. Okay, let me just leave it at dollar. Is it dollar in thousands or absolute amount? Okay, absolute amount. What is our pre-acquisition reserve? Which is as at 1st of September 2015, it was 21 positive. But as at 31st August 2016, it was positive 41. Hence, our post-acquisition profit is a movement which is plus 20. Okay, therefore we proceed. What is our goodwill, if any? Cost of business combination, PICO investments in ESCO. How much is that? PICO invested 51,000. And we measure NCI at acquisition date fair value. And this has been determined for us on the platter of gold. It was stated here that non-controlling interest is valued at full fair value, which was deemed to be what? $18,000 at acquisition date. All things being equal, this should be 69. What is our fair value of ESCO net assets as at date of acquisition? That is made up of share capital and share capital is 1 minute. Okay. Share capital is 20. And pre-acquisition reserve is 21. And this will have been 41, which is a book value. Now, we take care of fair value adjustments. Now, fair value adjustments, in the information here, we were told that when the fair value, the only difference arises from non-current assets, which is this non-current asset in the subsidiary. And that non-current asset here is the item of PPE. Now, we're told that the non-current asset was 23,000 greater than the carrying amount, which means when they fair valued it, the fair value amount is more than the carrying amount by 23,000. And what that signifies is that that adjustment will increase our reserve. And therefore, what do? We recognize fair value gain on PPE. How much is that? 23. But this gain has tax implication because the gain here from this does not affect the tax base, which means there is a future tax consequence on that gain, even though it's not subjected to tax today. But when it's actually realized in the future, therefore, the tax consequence will expose you to higher taxes. Such an event that occurred today that will expose you to higher taxes in the future is said to have created a taxable temporary difference. which results in the recognition of deferred tax liability. Invariably, what then now happens is that based on this tax consequence, on this, we need to recognize deferred tax liability. Therefore, I'll do this so that we can have better understanding. A, the fair value gain on PPE at acquisition. We create this accounting entry. A debit to the asset and a credit to our pre-acquisition reserve. With how much? With $23,000, not naira. And that's what we have here. And this is as a result of the information we have here. Now, what is the tax consequence on it? There is a deferred tax implication on the fair value adjustments. And what is the implication? Is that it results in a deferred tax liability, which is the tax rate multiplied by taxable temporary difference. Now, what is our tax rate? Our tax rate is 20%. Where do I get it from? This 20% here. And what is our taxable temporary difference? It is this additional 23 that impacts our carrying amount upward above the tax base that remain unchanged. And therefore, I multiply by 23,000. And that gives me 0.2 times 23,000. That gives me 4,600. Which means by doing so, it's going to be a charge on my gain, which means I gain 23,000. There's a tax on it of 4,600. Therefore, I'll debit my pre-acquisition reserve and I'll credit my deferred tax liability. With how much? With $23,000. Therefore, the second adjustment is a deduction of the tax consequence, deferred tax on the fair value of gain on PPE. How much? 4,600. Which means net, what is my gain? Net of tax is 80%. What is that? 23,000 minus 4,600 gave me 18,400, which is 80% of that 23,000. Plus my 41,000 will give me 59,400. And this 59,400 is the fair value of the net worth assets. Asset what? Acquisition. Why this is the book value of the net assets. Asset acquisition. Therefore, what is my goodwill? My goodwill, all things being equal, is 69,000 minus 59,400, which is how much? 9,600. Any question at this point?
So I wanted to ask, this debit pre-acquisition reserve and credit deferred tax liability, is it with $23,000 or with the 4.6?
With the 4.6. Sorry, okay. I wrote 23,000. No, it's with the 4.6. It's with what? The 4,600. Thank you. Any question?
Excuse me, sir. There was something like additional revaluation. How are we going to treat that? Is it going to come to this goodwill computation or not?
What do you mean by additional evaluation?
I think I read something like that in the question.
Okay, let's check. Where do we have that?
The last, if ESCO had received its non-current assets. The last paragraph.
Yeah. What does that mean? Are you sure you are interpreting the question well? Let me highlight it. Are you sure you are interpreting the question well? I want somebody to interpret that question correctly before I put my idea or thoughts down. Who will interpret it further? Who will interpret it further? Who will interpret it further? The floor is open. Or who will interpret it further? Nuruddin, read the question carefully.
Please help us to increase the funds.
Okay. What does that mean?
Okay. If
Read it
ESCO,
aloud. Okay.
if ESCO had revalued its non-current assets at 1st September 25, an addition of $3,000 would have been made to the depreciation charge for 20x5/20x6. Okay, I think as at the date of acquisition, the non-current asset was not revalued. It was recognized based on the existing carrying amount of the assets. However, had it been there was a revaluation as at the date of acquisition, additional depreciation will have been charged to 20x5/20x6. I think this revaluation will not affect the pre-acquisition fair value adjustments. Rather, the implication will likely go to end of the year adjustments.
Okay, thank you. I think you've given us some clue in this regard. Now, what it says is this: the evaluation you did then if it is S, the subsidiary that has done that evaluation. You know, remember, we said the fair value we are doing, it's not that we are reflecting it in the books of the subsidiary. This is just at group what level. The subsidiary will still carry the asset at its normal amount, which was the old carrying amount. They are not saying that if the subsidiary had revalued it in its own book, what would that give rise? It would give rise to additional depreciation more than what it was charged. What it simply means is that, similar to what we did yesterday, they are giving information for you to determine what is the additional depreciation that needs to be charged. Instead of them giving us the depreciation rate or basis that we can use to compare, if I use that basis or rate on fair value, if I use it on carrying amount, what is the difference? Now, they've technically done that difference for us, that had the subsidiary revalued that same asset and has recognized it in his book, the consequence of it is that it will have given rise to additional depreciation of 3,000, which then means that the additional depreciation we are now talking about, which we need to have computed on our own, has been given to us on the platter of gold. Go back to what we did yesterday. Look at this. Look at this. Now look at this. Now, this is the okay, yeah, it's saying clear now. Now, this is the fair value gain yesterday. Now, but yesterday, they gave us parameter that we can use to determine the depreciation. And we use that parameter on fair value, and we use that parameter on carrying amount to determine that additional depreciation is 4 million. But today, they've determined that 4 million for us, which stood at 3,000, because they've told us that add the subsidiary valued upward, the difference between the depreciation that was charged on fair value and the one charged on carrying amount is that $3,000. And that's it, what it means. What that means that additional depreciation arising from this will subsequently affect our group account as we move forward. Which that means I'll come here and say the effect of additional depreciation. Additional depreciation on PPE is a debit to subsidiaries' profits, which invariably, one, it will affect the parent, which is represented by the consolidated reserve, to the tune of, what percentage is that? 75%. Two, it will affect what? NCI to the tune of what? 25%. Now, 25% of what? Of the credits that will have gone to reduce the subsidiaries' asset value, PPE, which is $3,000. Now, 75% of $3,000, who can give that to me? And 25%. That 75% is 2,250, and 25 is 750. Now, remember, there was deferred tax effect as at the beginning. And every reporting date also, you must compute your deferred tax effect of what has happened during the year. Therefore, I'll quickly come here and say, what is my deferred tax implication? Of this adjustment? Is that the temporary difference will have reduced by the portion that has been depreciated. What does that mean? The temporary difference as at today, August 2016, is determined by referencing the temporary difference as at 1st of September 2015. And what was that? The temporary difference then was 23,000. And this 23,000, the impact, the current period is that you have more or less depreciated 3,000 out of the 23,000, because this 23,000 originates from this revaluation surplus. And therefore, you less the additional depreciation. And what was the additional depreciation? This 3,000. It means the portion of 20,000 is what is left. And this 20,000 represent our taxable temporary difference as at 31st of August 2016, which is equivalent of the balance in fair value after depreciation. Because of this 23,000, this portion of 3,000 has been removed this year, which means what is left, which is still part of the carrying amount of the assets, is 20,000. And you are going to see that in the balance sheet. Therefore, if that is the case, what then is the deferred tax? The deferred tax liability is our tax rate multiplied by taxable temporary difference. What's our tax rate again? 20%. What's our taxable temporary difference? In this case, 20,000. I remember this is as at the end of the year. Why the first one we computed was as at the beginning of the year when the acquisition took place. But this one is as at 31st of what? August 2016. And that gives us how much? 4,000. Now this 4,000 implies that before now, what was the balance we had? We had liability of 4,600. At the end of the year, the balance is now 4,000, which means there's a decrease in liability. When you have decrease in deferred tax liability, what does that give you? It gives you deferred tax credits, which is an income, which means deferred tax credit is the difference between my deferred tax liability at the end and my deferred tax liability at the what? At the beginning of the year, which is 4,600 minus 4,000, would give me what? 600. This 600 as a credit is to debit your deferred tax liability account in order to reduce it. And credit subsidiaries profit. This place is too small. What I'll do is to take it to the other side. I wanted to minimize it, maximize the page, but it seems it's too tiny. Okay, I can come here. I say my accounting entry. My accounting entry is debit deferred tax liability account with the 600, credit subsidiaries profits, which invariably affects one, the parent consolidated reserve, and that is what percentage? 75%. Affect two, NCI, what percentage? 25%. Now, what is 75% of 600? That's 450. And 25% is 150. Okay, that is the adjustment, which means at every reporting date, you compute deferred tax implication of your asset and liabilities. Now, what then do we do? Let's determine our consolidated reserve and NCI. Consolidated reserve, NCI. 1 minute. Okay. What do you have? PICO, retained earnings. What is it? Retained earnings of PICO is 96. What is the value of NCI as at acquisition date? Upon determining goodwill, the value was seen to be what? 18. Share of post-acquisition profits, ratio 75 to 25. Of what? We did analysis of $20,000. 75 of $20,000 is 15, and 25 is 5. Now, where are the adjustments? Other what? Adjustments. I'll number them one by one. The first adjustment, you trace it one by one from the beginning so that you don't miss anything. The first adjustment we did, none of them affected our profit. This only affected pre-acquisition, which we have dealt with. But there's an adjustment that affected our consolidated reserve and NCI because it affects the profits of the subsidiary. And what are they? A reduction in the profit of the subsidiary because of additional depreciation, which affect the parent with 225 and affect the NCI with 750, which means 225, if I miss it, a deduction because it's a charge on profit, and 750. This is additional depreciation on property, plant, and equipment. 2, this is where we stopped the other time. There's a deferred tax implication on it, which by the time we trace it up to it, it requires a credit of 600, which is like increasing your profit, reducing your increasing your profits because of the tax benefit. And in this case, it increases the subsidiary's profits, which invariably affect the parents positively with 450 and the NCI with 150, being deferred tax credit. Deferred tax credit on PPE based on depreciation, and that is 450 positive and 150 positive. What other adjustments? I think we've wrapped all of the adjustments. Therefore, all things being equal, what is our balances? 96,000 plus 15,000 minus 2250 plus 450 give me 109,200. 18,000 plus 5,000 minus 750 plus 150 give me 22,400. Any questions so far? Any questions so far? Any questions so far? Okay, in the absence of no question, therefore, we show our balance sheets. Now let us show our balance sheets PICO. Group. Consolidated statement of financial position as at 31st August 2016. All figures in dollars. Assets, no current assets. Property, plants, and equipment. What are they? From the question. Let me try and copy the question. So I can just navigate easily there. Now, 63 for the parent and 28 for the subsidiary. I come here, 63 and 28. Let me check again, 63, 28. Now, but there are adjustments that we made. The first adjustment was that we should increase PPE of the group by 23,000 because of the fair value that originated at acquisition. Therefore, I will increase it by 23,000. Second, there was an adjustment for depreciation after 1 year. And the adjustment is this. It says the additional depreciation should reduce the subsidiary PPE by 3,000 because of the depreciation. Therefore, I reduce it by 3,000. If you check, the 23,000 and 3,000 is what produces this adjustment of 20,000 that is added to the original amount of 91,000. When you add them together, you have 91,000 plus 20,000. It give you 111,000. If you recall, this 20,000, this asterisk is not showing clearly. This 20,000 is what brought about these are taxable temporary difference as at the end of the year. All because before now, it was 23,000. During the year, because of this depreciation, it reduces to what? 20,000. Which means this is the temporary difference at the beginning, this is the temporary difference at the end. The movement in it will create deferred tax credit or deferred tax charge. And that is that. Goodwill, investment cancel out, leaving out goodwill. What was our goodwill? Our full goodwill was 9,600. All things being equal, that should give me 120,600, which is my total there. Current assets. My current assets here is 82, and for the subsidiary is 43. I'll come here, 82 plus 43,000. That should give me 82,000 plus 43,000 should give me 125,000. When I sum them together, my total assets is 245,600. Thereafter, I recognize my equity and liabilities. Which is made up of share capital and reserves. Share capital, PICO. What is the share capital of PICO? 80,000. Retained earnings, as consolidated. What was the consolidated retained earnings? 109,200. 109,200 plus 80,000 give me 189,200, which gives me my equity attributable to PICO. What about my equity attributable to non-controlling interest? That is 22,400. 22,400 will give me total equity of 211,600. Now I have my liabilities. Non-current liabilities, I have my deferred tax. My deferred tax liability, as at the end of the year, is 4,600, 4,000, which is the difference between 4,600 at the beginning and 600 credit, which will still give you the same thing. Which means my deferred tax is the difference between 4,600, which was recognized at the beginning, and the credit that was released of 600 during the year will still give me the 4,000. Next is current liabilities. Let me assume all my current liabilities are payables, trade payables. What is it? Trade payables. Current liabilities here is 20, and current liability here is 10. Therefore, I'll come here, 20 and 10. That gives me what? 30. All things being what? Equal. My total equity and liabilities is 211,600 plus 4,000 plus 30,000. That gives me 245,600. And our total asset is also 245,600. Let me show you at a glance. Any question? Any question at this point? Any question at this point?
I must say that the explanation is very clear, but it builds on me to still go back and look at it again and maybe compute it myself so that it can sink. Yeah.
Okay. Any other question?
The same thing applicable to me. I think the area of deferred tax aspect of the question is what make it to be trickish somehow.
Okay. Not only the tax, this aspect also make it tricky because of interpretation you give to it. If ESCO had revalued its non-current assets, which is PPE, as at 1st of September 2015, an addition of 3,000 would have been made to depreciation charge for the year, which means between 2015 and 2016, which is just 1 year. That interpretation is also key to it. Any other question? Any other question? You guys are too quiet. Is it that reality is done or not? Any question?
This is group account, sir. It's not more, sir. It's a serious matter.
Okay. Now, general question before we wrap up for today. In preparation for new journey that will start next week, we'll put a pause a little to business combination and group account. And I think next week, someone will come in to discuss on presentation of financial statements. Okay. And from there, we'll start to introduce you to various standards. And you see the practical aspect of the application of those standards to financial statement you prepare and you present as a general purpose in line with IS1. Any other question?
Sorry, I want to ask a question.
Yes.
Sorry, like in a typical question, when they talk about dividend paid, maybe when they mention dividend paid as a phrase, as part of the question, how can we deal with dividend paid in group accounts like this?
Okay, when you get to profit or loss, we'll see the implication of dividend as an income and how that will be eliminated. But if it has been paid, it has no implication on the balance sheet because it's already off the balance sheet. What you find out is that it's only when it became payable, which reflects on balance sheet, is where we are to eliminate. But that is when we get to group adjustment. Okay, the next phase, which we're supposed to have started today, was other principles in business combination and group accounts, vis-a-vis moving on to group adjustments. Is that okay?
Yeah.
Okay, I'm going to send this, the solution to your chat, both at WhatsApp page and at chat box here. Any other commentary before we go? Any other commentary before we go? You can pick it up in your chat box.
Okay, if I can just, okay, sorry.
Okay, yeah.
If I can just ask for something, is it possible for us to have like a template of consolidated accounts, the templates used to prepare consolidated accounts where you consolidate the parents and the subsidiary, consolidate their assets and things like that at the end of the class, maybe?
Okay, the issue is this. There's no template other than the template you design based on the nature of your company. What it means is that is your line of items within your financial statement that are used to create your template, which you call group reporting pack. For example, your group reporting pack will replicate every common lines plus unique lines that you have. Okay, probably towards the end of the whole program, when we have acquired the knowledge first and we are now deploying some tools, we might get to a level where we just want to look at it from how do we develop a group reporting pack. You understand? It is what is unique to you. And you use the principle you have learned here, plus your understanding of making use of Excel to do such a reporting pack. Again, after they've taken you through presentation of financial statements, what also is going to happen is that I'm going to ensure that I take you through, I'll take you through modeling financial statement using Excel and pivot table, okay? And also, how do you, from the scratch, develop an accounting system through chart of account and etc. What I'll do now is that let me send you a video on that first.
Okay, sir.
And I'll send you a video on that and probably, okay, let me try and go to my page. You can go to my page and subscribe, but I can extract it from my page on
You
YouTube.
subscribe already.
Okay, you'll see it there. And there are other ones I can share later on, but let me try and go to my page there. Where's my library? Okay, I'm sharing the link on this chat, and I'm also going to share the link on I've shared the link on this chat. You can watch that. Okay. And when you are watching it, you can change it to high definition, which means you can go to the setting and change the quality of the video so that it can be sharp as 1080p. Okay, I'll share the video with you now as I'm trying to play it. In terms of class of, just wait, I'm going to share the screen. Okay, good morning, everyone. Welcome to this session on presentation of financial statement with the aid of dynamic Excel model application. And we are going to harness two things: our knowledge of Excel application on a standalone and our knowledge of the requirement of IFRS, starting with the presentation of financial statement IS1 and other supporting standards. Now, in this case, we'll more or less look at conventionally in practice, how do we make use of Excel in preparing financial statement of an entity. And today will more or less be the first session or part one, where we'll look at a simple trial balance without more or less comparative figures in order to have the first level of understanding how we can apply Excel in this presentation of financial statement. Now, typically, this is a trial balance. And what is a trial balance? A trial balance is a list of all balances of accounts for a particular period. And every trial balance will contain the 5 elements of financial statements. And if you recall, the element of financial statement are as follows. Element of financial statement. And this element of financial statement is as depicted in the conceptual framework. And we are all aware of the requirement of the conceptual framework, which is the bedrock for financial reporting. Now, there are 5 elements of financial statements. 2 elements depict the financial position. 3 elements depict the financial position. And what are the elements? 1, we have the assets. 2, we have the liability. And 3, we have the equity. As you are all aware, assets deals with economic resources, which means we are not interested in the physical substance of what it is. Rather, we are interested in every economic resources that is controlled by the entity at a particular point in time. And that's what matters to us. And likewise, liability should be those present obligations which the company is bound to pay at a later date. And likewise, our equity will always be the residual interest in the asset after settling all the liabilities, which means our equity will always be the difference between asset minus liability. And in that light, our equity will be our share capital plus all categories of reserves we have. Okay, now the second level is financial performance. Now, there are 2 elements that measures our financial performance. The first one is the income, while the second one is the expenses. Now, what is an income in this light? Now, from the position of the conceptual framework, income is not necessarily arising from when you more or less sell items or you render services, but rather income emanates from the use of your assets and liabilities. And what does that mean? It means that when you look at income, income is derived as in your equity, which will have resulted from increase in your assets or decrease in your liabilities. Okay, and what does that signify? What it signifies is that you can make income from outright
carrying on your course of business, which means you sell goods, you make income, or you render service, you make income. But you can equally make income passively based on your exposure to certain categories of assets and liabilities. For example, if you have investment, you make income if that investment increases in value without even doing anything. You could make income if you have foreign currency, and based on the changes in the exchange rate, you might make income, which means it's not until you create an activity that you generate income, but merely having an asset that continues to appreciate in value, you create income. Merely having a liability that more or less reduces in value, you earn income. For example, you bought goods on credit when Naira was 450 to $1. Therefore, you have a trade credit of 450,000 because you bought goods of $1,000. Invariably, today, let's say Naira has appreciated to 380, which then means that if you are to settle that $1,000 today, instead of settling with 450, which was the rate as at that time, you are settling with 380, which means you have made a gain even from a reduction in liabilities. Or where you are given a rebate on your liabilities to facilitate immediate payment or quick payment, that also brings about an income, which means income is the generality of any impact in your equity arising from your increase in an asset or decrease in the liabilities. Likewise, expense is the opposite of it. Okay, expense arose where you have a reduction in your equity, and this reduction can be attributed to either a decrease in your assets or an increase in your liability without considering distribution to owners of equity. And that is just the position we need to understand, which means when we have this at the back of our mind, we better appreciate what it is. Now, let us relate this element to what is contained in this trial balance. Now, first level in a trial balance is that in setting up your accounting system or GL management system, you start from what we call coding of accounts. Coding is very key in order to segregate accounts into various elements and various classes. Okay, and first is that you find out that you can code it in any manner that you appreciate, but it must follow certain conventions. Those conventions is to, first of all, ask yourself, are you a single company? Okay, ask yourself, how many business divisions do you have within the company? Ask yourself, how many departments do you have within the company? All those ones are based on the nature of the business. But what is generic accounting-wise is to ask yourself, what are the elements you have? And you can't have more than these 5 elements. Now, within this element, what are the subgroupings in terms of class of assets, in terms of class of liability, in terms of class of equity, and in terms of aggregate level of your income and expenses? Okay, and that's what we need to understand. What that means that, for example, when we have assets, our coding can be, that, okay, for class, these are coding. Now for elements, I can say elements, everything that starts with 100 is asset. Anything that starts with 200 is liability. Anything that starts with 300 is equity. Anything that starts with 400 is income. Everything that starts with 500 is expense. Now, if I go by this, the next thing is that I'll ask myself, class. Now, if you check it later on, you find out that your assets, I can further group it into property, plant, and equipment. I can further group it into intangibles. I can further group it into investments. I can further group it into cash and bank. I can further group it into trade receivables. I can further group into other receivables. I can further group it into other assets. Let's assume these are all assets we have at hand. Okay, therefore, by class, I can say for PPE, all class of PPE will start with 100. All class of intangible will start with 200. All class of investment will start with 300. All class of bank will start with 400. All class of receivable will start with 600. All class of other receivable will start with 600. While trade receivable is 500, and all other assets is 700. Now, that is that. Now, also, within these assets, I can start to create the following, which means subclass. I can create it under this. I could have property, which is land and building. Under this, I could have equipment, office equipment. And finally, I could have under it motor vehicle. Therefore, which means in this class, I can make this 100, 200, 300. Now, for intangibles, I can have two categories there. For example, everything we are doing is hypothetical. For intangible, I could have, let me say, I have trademark and brands, and I have software. Okay, I could make it 100, 200. Now, in investment, I could say I have equity investment. I could say I have bond investment. Okay, I could say it's 100, 200. Okay, for cash and bank, I could say I have petty cash, that is cash at hand. I could say I have demand deposits. And I could say I have tenor deposits, that is fixed deposits. Now I could call this 100, 200, and 300. Now in my receivable, I can have two categories, hypothetically. I could have third party debtors. For example, I could have intercompany debtors. Okay, other receivables, I could just leave it like that without any breakdown, or I can still have it in terms of third party. Third party, other receivables, and intercompany receivables, other receivables. Okay, I could make it 100, 200. 100, 200. Now, other assets, I could have other assets in form of, let me say, I have withholding tax credits. I could have prepaid expenses. And let's say that is all. Now, in this slide, I could have 100, 200. Now, let me assume that this is the maximum breakdown I could have. Therefore, what is my account code? My account code is simply, remember, anything that is blank there, this is 100. How many codes in all? You'll find out that when we look at the digits, that is 333, that is 6. Therefore, in this case, I'll show you that this is, that's 6. Is it 6? No, this is 7. Therefore, I can generate the code. This will be, because everything here is 100. Everything here, the way I have this is 100. Everything here is 200. Everything here is 300. Everything here is 400. Everything here is 500. Everything here is 600. Everything here is 700. Okay, now every other space like this are blank. And you know why? Because those ones are what we call the control account. Are what we call the what? The control account. And I will explain that later. Okay, this 100, 200, 200, 300. Now, what I'll do is that all this aspect of control will be 0, 0, 0, 0. That is 0, 0. Now, to show you the way I wanted, I can ensure that every of my item there has 3 digits. You already know how to use Excel. You go to Format Cell. Okay. I go to Custom. I customize it to digits so that it's now ready for coding. 0, 0. So that all those where I have 0, I have 3 zeros showing. Now, what I can easily do to create my account, instead of doing it manually, is that I can concatenate it. Okay, there are 7 digits in all. Is it 7? No, there are 6 digits in all. Okay, this is giving me, okay, those are the control accounts. Now, you find out that these are the control accounts. Okay. Well, let me standardize it. I'm trying to manipulate it to give me something nice. I'm coming. Now, you can see that it's giving me something nice there, but I think what I can do again is to okay, no problem. Let me try something else in order to merge it. Okay, I think another way I can do it is to convert this to text. Let me try and convert them to text instead of digits. Okay, can you see? Which means, you know, you must be able to manipulate Excel, which means I've converted it into text so that it can see it as a code rather than as numbers. Do you get it? Which means one thing you need to understand is that there's no exact science to solving problem. It's for you to iterate, find manners to solving it. It's not like you want it to be like 1 + 1 = 2 every time. No, you must be able to think far and wide. And that's why you must throw away error boxes when we are trying to develop anything. Okay, now we have been able to generate the code successfully. Now this is for assets. We can replicate the same for liabilities. Let us try to replicate it for liabilities. I can have my liabilities into this following category: trade payables, accruals and other payables, tax, current tax payable, and let me say bank OD. Okay, yeah, I can replicate the same thing I have here. Third-party creditors, intercompany, trade creditors, or payable, accruals, okay, we have other payables, third party, other payables, intercompany, other payables. Okay, yeah, I can see I have what's common to us is company income tax. Let me see, tertiary education tax. Bank would let us see it as, let me just pick one bank. Let me just pick one bank. I'll just say open line of credit revolving. Overdrafts, OD. Okay, therefore I can code it. Okay, my trade payable I can say is 100. My other liability I can say is 200. My tax I can say is 300. And my overdraft I can say is 400. Now under trade payable, I can say my trade creditor is 100 and my intercompany is 200. I do the same thing here. I do the same thing here. Now probably I'll just say 100. Okay, now let's go to my equity.
Intercompany trade payables. You need code that. Intercompany trade payables.
We coded, okay. No, it's accrual within code. Accrual 300. Okay. Now equity is 300. Under equity, we have share capital. We have share premium. We have retained earnings. We have those ones that are common, evaluation reserves. Let's say the last one we have fair value reserve. Let's assume that those are the items we have. Under that. In that case, I can call this 100, 200, 300, 400, and 500. Now, I can still further break it down if I have different share capital structure, ordinary share, preference share, or I have different classes of shares. You could also break it down. But in this case, I won't break it down. Therefore,
Hello? Hello? Hello?